Hi, my name is Steve Clapham and welcome to another video in the Valuation 101 series. And this is the first of a set of videos that I'm going to record about using stock market valuation multiples. And we're going to start with the PE. And the PE is the most common and the most popular ratio. You can see here that I've put down a whole bunch of market cap based and EV based multiples. And I've classified the PE into three. So you can have a trailing PE, a forward PE, and a relative PE. And I'll talk a bit more about those as I go through the video. The PE is the most common tool. I've shown you the PE range for a company that we're quite interested in, a company called Ontex. Ontex is quoted in Belgium, and it's a manufacturer of diapers. This is a stock that we use in our How to Read the Balance Sheet and the Other Financial Statements course, which you can read more details of on the website. And you can see that Ontex, we think, is a particularly unclean company when it comes to its accounting. So it's quite aggressive in its accounting. That's why we use it. You can see the massive derating that it had after we started following it. But the PE is probably the most common tool in investment research. You cannot pick up an analyst note without some discussion of the PE, unless the company's a loss maker, where obviously it doesn't apply. You can't use it. And the reason it's so widely used and understood is it's very clean, it's very simple. The main problem with the PE, and we'll come back to this in another video where we'll look at accounting quality and the quality of earnings. The main problem with the PE is the definition of the earnings that are used to calculate it. And too many companies have too loose a definition of what their earnings are. Almost every company, for example, includes stock-based compensation, which for tech companies can often be a very significant element of the people's pay and is actually very significant to revenue. But when we're looking at PE, what I like to do is I like to look at the PE historically, the PE this year, and the PE next year. And I like to look at that both in absolute terms and relative to the local market. This slide shows you that this is the FTSE 250. This shows you the distribution of earnings multiples across that group. This is actually a slightly old slide. But the valuations haven't changed that much, in fact, because the UK market's been pretty much of a laggard. But you can see that the overwhelming number of frequency of PEs is in that 10 to 20 range. When you get outside that, it's really, really unusual. And this slide just shows you the forward PE from JP Morgan, talking about where is the valuation and where is subsequent returns. And there's quite a good correlation between what you're paying for the market and how much you'll make from the market in the following 10 years. It could be argued that because we've got very low interest rates and because it's unlikely that those interest rates are going to go up all that much for quite some time, that the forward PE today, although it's very high, may not have as good a correlation and it may not follow exactly this track as it has in previous years. And this is the Bank of America Merrill Lynch showing exactly the same thing. Long-term valuation is almost all that matters. And forward PE is a good, clean, simple way of encapsulating particularly a market valuation. We think it's less good when it comes to individual companies, and it needs to be used in conjunction with other measures. It's dangerous to use it on its own. Interestingly, this is the UK consumer discretionary sector, and this is an analysis done by a friend of mine, Adam Rackley at Cape Wrath Capital. And what he showed was that, in fact, the PE had very limited relationship to the current year EPS growth, or even the 2-year average EPS growth. I was slightly surprised by this because I would have expected there to be a better R-squared factor for it. But let's talk about some of the fundamental drivers of the PE ratio, because this is what's really interesting. Because often you'll get two companies which are very different, but have the same PE. And how do you think about that? This is an analysis from McKinsey. McKinsey, probably the valuation gurus in the world. And they're just showing you an implied PE multiple, so they've calculated this according to a valuation formula, of two different companies. One is growing quite fast. It's got expected growth of 13%. And it's got pretty reasonable return on invested capital, 14%. The other company is growing much more slowly. It's only growing at 5%, but it's got stellar returns, 35% return on capital. And they both merit the same PE multiple. And the reason for this is the PE multiple is incredibly sensitive to growth. And this is a slide from Morgan Stanley, actually, showing the warranted PE multiple as you increase the growth rate in that NOPAT measure. NOPAT's a very simple measure. It's not shown in the accounts, but something you can easily calculate. It's the net operating profit after tax. So you simply take the operating profit, or EBIT, and you apply the company's tax rate to that. The reason for using NOPAT, and it's very popular with academics, is it takes out distortions from the company's capital structure. Obviously, we've got very low interest rates today, so if you've got a lot of debt, you can make your earnings growth look a lot better, and you can make your PE multiple look a lot lower. So using NOPAT is a better way of looking at that. And you can see that as that growth rate increases, and particularly as it increases above 15, 20%, the valuation multiple that's warranted goes through the roof. It's almost exponential. But that's not the same with growth in returns on invested capital, because as the ROIC goes up, you don't see the same geared exponential effect on the PE. This is a slide from Goldman Sachs, and it's quite a clever slide, because one of the things that they do is they look at the S&P 500 valuations, and they look at it, the valuation relative to the consensus long-term growth expectations. And what they've done is they've plotted this over really a long period, 35-year period. And they just said, well, where are you today relative to that long-term period? And you can see here, this chart is actually slightly out of date. You can see here in March 2000, the valuations that were applied to companies that were growing very quickly were off the chart in terms of they were much more highly rated than they'd ever been in the past. And this sort of analysis is a very good way of understanding what the market is looking at, and PE is a great way of encapsulating that. So what are the conclusions on PE? The first one is there's no magic bullets in valuation. Yes, the PE is the simplest and the easiest tool, and it's very useful, but encapsulates a lot of data very quickly. And it's recognizable, it's intuitive. When you look at a company and you say it's on a PE of 20 or a PE of 30, investors immediately understand what that implies in terms of growth and in terms of opportunity. And the particularly important point about PE is the progression of the PE over time is incredibly informative. So I will always look for a company that's on a premium multiple. I'll always look at how fast that multiple falls, because if it's on a premium multiple, I'm expecting it to grow quicker than the market. But you need to be careful, because the PE can be affected by high leverage, especially in today's low interest rate environment. High debt on low interest rates may mean that you've got a company whose PE looks very low, but when you apply an EV/EBITDA or similar enterprise value-based multiple, it's not nearly as cheap. It's also very affected by low tax rates. And this is particularly important today because it looks probable that we'll see an increase in US tax rates and probably in tax rates elsewhere, because every country, in the world has got a lot of debt. Every country has been affected by the pandemic. Government debts are very high. How are they going to try and get the debt down? The corporate sector is a good place to start. The other thing that you need to be quite careful of when you're looking at PEs is that the adjusted earnings per share, which are popularly used by sell-side analysts to calculate the PE, may not be a reliable indicator, because often companies present an adjusted PE, which is, in my view, overly aggressive. And we'll come back to that in a future video. And obviously, when you're looking at the PE, it doesn't take into account the returns. So you've got to look at the returns and make sure that the returns justify the multiple that you're paying. I hope you found this video useful. Thanks for watching. Watch out for future videos in this valuation series. And don't forget, please subscribe to the channel.